All right, so now we've generated to date and get to the formal financial statements of the balance sheet and income statement. We do this because this is where we measure if and by how much we're short on cash. Give you a hint, we're short on cash. All right, so we start with the operating items, and then we will then put on our preliminary policy as far as financings. And we say we're going to grow dividends by 10%. The board may have stated that as an objective, not a requirement, but an objective. So let's try to meet that. And then we're also saying that we're not going to raise any more long-term debt. We're not going to sell any more stock. And if we need money, we're going to draw down on our line of credit. Interest rate is just information, is at 8%. We're going to need that for calculations. Interest expense is based on the amount outstanding for the whole year. So what we're going to do is go through all the analysis and see how much cash we're short. If we're short of cash, we call that a financing deficit, then we're going to draw on the line of credit and essentially borrow money. To make things easy for the moment, let's just assume that we only borrow on the last day of the year. I know that's very unrealistic. You're probably going to borrow when you need it. But we're going to do that as a first pass because otherwise we have to keep adjusting our interest expense. So that's just for simplicity. We'll relax that in a moment to show you how it would work if we do borrow during the year. And then if we have extra money, then we'll get rid of the extra money by either paying a special dividend or repurchasing stock or buying marketable securities, build a little war chest. Let's do those statements. So I'm going to hop out into Excel and we're going to do the balance sheet first. So balance sheet, we've done most of the work already. 2016, we just laid those out here. And we know the forecasting. So it's 1%, 14, and 20 of sales. And we've done this before, so we just pull those numbers forward of 22, 308, 440. And if you want to do it longhand, you do it again. You take the sales, rather, for 2017 times 1%. We do that for each of the items which we've done previously and net fixed assets. So now we have this number. This is the total assets that we're going to need. So we see there's an asset growth of $120, right? That's how much we have to do to support our growth in sales. Next, we do the forecast for accounts payable and accruals, which is 4% or $88. For now, we're going to leave line of credit 0, and we may need that later. Hint, hint, we will. Then we have no change in long-term debt, so carry that over. Then we have no change in selling stock, so we carry that over. That's this number. Then retained earnings. What we're going to do is take the old retained earnings plus the profits minus the dividends, leading to our total of liabilities and capital of 1261. Our balance sheet does not balance. Notice that this number, 1320, does not equal this number, 1261. So what do? We're short 59. Guess what? We're going to put the 59 over here, right? We're going to borrow the money. We'll just stay put for a moment. We'll do that. That's just a little preview. Next, we'll do the income statement. So income statement, start of sales, 2200, then the same ratios we were using along. We were actually all the way down to EBIT. Here, now we're going to have interest. We have 8% on the bonds that we had outstanding of $500. So we'll pay $40 on the long-term debt. Since we're not going to borrow money to the last day of the year, there will be 0 interest for the year. We may have a balance that we owe, but there's no interest yet because we haven't yet used the money. Again, simplifying assumption. So then we have a pre-tax earnings minus taxes equals net income. Regular dividends of $22, which is the 110% of the prior year. Last year we were at 20, this year 22. So 75 net income minus 22 equals 53. The 53 we see up here. 200 plus 53 equals 253 right here, right? So that's how they stick together, or we call it articulation, where we have the income statement flowing into the balance sheet. So now we're ready to go. Because if we add the $59 there, then our total assets is 1320. Total liabilities and equity, same number. So we're in balance. All right. That gets us back to our scenario of we've projected income statement, we projected the balance sheet, and then we see that there was a surplus, the $59. So we essentially plugged it by saying that we're going to draw a line of credit, and we end up with this. The balance sheet where it balances, 1320, and it's because we borrowed $59 from the bank under a line of credit. So we step back and we say, well, how does it look? Well, notice that the income statement was not adjusted at all, even though we know we borrowed some money. So this line here is a little bit here, this 8% beginning line of credit. That's a little unrealistic because it assumed that we didn't borrow on line at all during the year, and that somehow all our vendors would wait until the last day of the year. So that's a little bit unrealistic. But we didn't touch other income statement accounts. Furthermore, what happens if we release that constraint? If we release that constraint of financing only at the end of the year, what happens is we have line of credit increases. Let's say it happens mid-year, just pick an example. Then interest expense goes up, which makes net income go down, which means we have to have less reinvestment. That the whole profit margin times 1 minus the payout ratio will yield a different number. So now we need more money, so then we have to borrow more money. So this becomes this circle. There's a little bit of circular logic. In fact, when people try to program this in Excel, they get circumreference error. So there is a way to do it through iteration. And eventually when you iterate, the difference gets smaller and smaller and smaller, and eventually you don't care. If you want to see an example of iteration, you can see this in the student downloads. It's in the toolkit.